And today I'll be talking about recession-proofing your real estate investments. And during our time together, I'll be covering the following. We'll have a brief discussion about the concept of markets. We'll talk about the economic cycle and recessions. I'm going to explain what we mean when we say A, B, and C class properties. And I'll share with you 5 tips for real estate investing in a recession. But before we do that, just a quick disclaimer. So myself, John Bowman, I provide real estate services as a realtor. The information found in this presentation or on my websites, the investingatcalgary.com, johnbowman.ca, or investing in Calgary Real Estate, are not intended to provide investment advisory services. The real estate investments provided here are as examples only. Real estate investing has inherent risks, including the possibility of loss of principal amount invested. Past performance is not indicative of future results. And as with any investment, any decision to invest in real estate should be approached cautiously and after analyzing all possible risk factors. So just quickly here, I know Monica provided a fantastic introduction. Thank you again for that, Monica. But to tell you a little bit more about me, I returned from school abroad to Canada in the late 1990s, where I met my wife. About 20 years ago, the very first property we ever bought, we initially kept and rented that out. Eventually, we did do a private deal and sold that to the same tenants, but shortly after, we started buying and flipping homes. After the birth of our daughter, and while, as Monica mentioned, working in the Calgary energy sector, I returned to school and completed my MBA. In school, I focused my major project on real estate, and I couldn't wait to implement that theory in the real world. In the years following, I took my entrepreneurial spirit and passion for homes to real estate, becoming a realtor. Hard work and a true passion for business has helped my reputation as a qualified realtor quickly rise. I'm also an investor agent. When I'm not helping others achieve their investment goals, I'm an active investor who owns and manages multiple investment properties. So, markets. When it comes to explaining markets, there's a lot of really good resources out there. One particular resource that I like is a book by Jay Scott called Recession-Proof Real Estate Investing: How to Survive and Thrive in Any Phase of the Economic Cycle. In this book, Jay explains the concept of markets. But to understand markets, we first need to take a step back and talk about transactions, the concept of transactions. Every day, billions of times per day, financial transactions take place between buyers and sellers. Buyers pay in the form of cash or credit, and in return, sellers provide goods or services. One might purchase a coffee with cash, a car through a car loan, a home through a mortgage. These billions of transactions per day are based around thousands of goods and services. A market is the aggregate of all the transactions around one of these goods or services. As an example, the stock market involves all the transactions that are around people buying and selling public stocks. There are markets for textiles, coffee, furniture, oil and gas, pretty much anything you can transact. In real estate, the residential real estate market is the sum of all the transactions around the purchase and sale of housing. Before we talk about recessions, though, it's important to understand what we mean when we talk about the economy and economic cycles. When we talk about the economy, we're talking about the sum of all the transactions within all the various markets. Now, the number and size of each of these transactions will not be the same all the time. There'll be months and years where the size and cost of these transactions will be more than other times. When we see bigger and more transactions over a period of time, we typically refer to the economy as strong and expanding. There'll be times when there are fewer and smaller transactions that take place. During this period of time is when we would refer to the economy as weak or contracting. Of course, this is an oversimplified version of the economic cycle, and there are many factors that affect the economy, including fiscal policy, manufacturing, unemployment rates, and so on. But this pattern of strong to weak economy, back to strong economy is called the economic cycle. Strong to weak and back to strong is one full cycle. These sort of cycles happen regularly, and we've had 33 of these economic cycles over the past 160 years. Simple math tells us that the average cycle lasts about 5 years. So on average, we have a recession every 5 years. Today, we'll be focusing on the downturn in the cycle, of course, aka a recession. GDP, or gross domestic product, is a measure of the total output of the economy. When the government sees 2 consecutive quarters of a drop in GDP, that's typically when they declare a recession. In a recession, we typically see a lot of housing inventory on the market. We see sellers willing to chase prices down. Some sellers are trying to get out and capture the equity they gained in the last expansion. We also see lending get tighter in both the hard money, private lending, and in the conventional spaces through banks and so on. From a real estate perspective, we'll see a number of leading and lagging indicators. These include housing inventory at or above 6 months. What this means is that based on the average number of monthly sales, it will take more than 6 months to sell all the housing on the market at that point in time. We also start to see mortgage defaults and typically see a drop in house prices. Generally speaking, the housing market shifts to a buyer's market, meaning it's more advantageous for a buyer than a seller in the housing market. A, B, and C class properties. Now, there are a lot of opinions out there regarding A, B, C classes on properties. Brandon Turner at Bigger Pockets has some interesting insight on this, and according to him, an A-class property is typically located in an area with new buildings, hot restaurants, great schools, and expensive real estate. Tenants earn high incomes, and properties are rarely vacant. This is truly the best location you can find, and the highest quality tenants want to rent here. An A-class building is generally newer, probably less than 10 years old, and therefore has fewer maintenance issues. The building has high-end features such as stone countertops and hardwood floors. Properties will be well located, close to amenities, nicer neighborhoods, or close to downtown, depending on your area. We had the presentation on Victoria earlier. I would imagine that the closer you are to the water, the higher the rents, and that would constitute the A-class properties. So A-class properties generally command the highest rent, but may provide a lower amount of cash flow because purchase prices will be higher. B-class properties, a Class B location, might be slightly older than its A-class cousin, but it still has decent restaurants, shopping, and schools. Typically, these areas are 50% owner-occupied, with the other 50% owned and with tenants. This might be your middle class area where tenants have slightly lower income than those in Class A properties. A Class B building is probably 15 to 30 years old. These homes lack the shine of the Class A property. Rental income is generally lower, and maintenance costs are higher due to the age of the home. However, you can add value here. These properties easily upgrade to a B plus or even an A property with renovations and improvements. And then lastly, C class properties. Class C locations typically have tenants with lower incomes than in B class areas, and homes are older, say 20 to 30 years or more, and that's without any historical valuation. This area is generally less desirable, and many properties show visible deterioration. The neighborhood is likely a bit farther away from shopping, restaurants, and so on. A C-class building, too, is likely older than 30 years and probably looks the part. They need frequent repairs, so plan for ongoing maintenance. Systems like plumbing and electrical may be outdated and require ongoing attention. Properties will typically rent for less, but will be much more affordable because of their lower purchase price. These properties are predominantly investor owned and tenant occupied. While they offer the highest cash flow on a percentage basis out of all the classes, they require hands on, sometimes full time monitoring and management. Now, the graphic on the right was meant to represent that during a recession, we'll see a shift with renters and homeowners alike. As many of the high earning tenants or homeowners lose their jobs or try and lock in equity they earned in the last market expansion, they'll sell their homes. They'll move from the A to the B class or from the B to the C class to save money. A and B properties are hit the hardest in recessions. So on with the tips. Tip one is in investing in a recession is to buy in great school districts. Data shows that prices fall less in great school districts. This means you'll have the largest pool of buyers and the most opportunity to capture the highest resale price if you focus in these areas. Related to this, focus on areas close to universities, colleges, polytechniques, and so on. Typically, year after year, students will continue to enroll in college and university. COVID may be an exception. And of course, we had the presentation out east. I think it was Peter or Renee. Apologies if I got that wrong. I think it was Renee who was talking about the drop in college enrollment and how to manage that. But typically, again, year after year, students will continue to enroll in college and university. During recessions, people who are displaced from work use this as a time to go back and learn new skills or go back to school for an advanced degree during a recession as a way to further their economic prospects upon graduation. Tip two, flippers should focus on median prices. So generally speaking, flipping in a market downturn is risky. However, if flipping is your thing, tip two is to focus on the median prices in your area. In Calgary, the median price of a detached home in October of 2020 was $478,800, so almost 500 grand. If you're a house flipper and the median price of a home sells for 500,000, you shouldn't try and flip homes in the $700,000 or $300,000 range. And that's what this graphic was meant to demonstrate. The bulk of the activity in the sales and your potential buyers are happening at or around that median price range. And data indicates that sales activity in houses well above or well below the median price point tend to slow faster than those in the median range. According to Jay Scott, whom I previously referenced as the author of Recession-Proof Real Estate Investing, this is because buyers in the high and low ranges are more at risk of losing their jobs and therefore find it difficult to find financing for the purchase. Tip three, I won't spend too much time on this as we had that great presentation by Dan. However, tip three is to refinance into lower interest rates if possible and to pay down any oversized loans. With mortgage rates at historic lows, it's an opportune time to refinance. You may need to consider penalties for breaking mortgage commitments, but there are options like a mortgage blend and extend, or as Dan pointed out, sometimes the savings outweigh the cost of the penalty. So partner with a good mortgage broker who can assist and help you evaluate options. The RP team can help connect you with the right mortgage broker. Of course, this doesn't just apply to your investment properties. I'm not a financial planner, but I think it's pretty obvious that this philosophy can be applied to your personal home and debt obligations. Tip four is to maximize rental revenue. Increase rents to market rates if you haven't done so already, and identify any other low-cost ways to boost revenue. Ideas include looking to separately meter utilities, installing coin-operated laundry machines, renting garages and so on. I know in Calgary, a garage on its own, a single car garage, can rent anywhere from $200 to $300. So if you have a couple garages behind your rental property and the tenants aren't using them, there's $600 a month just sitting there waiting for you to collect on. Lastly, tip 5 is for the buy and hold investor. As I've pointed out, during a recession, focus on C-class properties. During a recession, we often see rents and occupancy rates drop in A and even B-class properties. This is because renters are losing their jobs and seeing a reduction in hours and wages. They're looking for smaller, less expensive housing and will often move down in housing class. But as I often like to say, everyone needs a place to live. And because C-class housing will generally give you the best bang for the buck for renters, it tends to hold up the best. Even post-2008, C-class rents continued to climb and occupancy rates increased. With housing prices in the market segments like the semi-detached products down at the moment, now may be an opportune time to buy. Unlike home prices, rents have not come down, generally speaking, and there are some remarkably good opportunities to buy strong cash flowing properties in Calgary. Calgary is now also one of the most affordable big cities in the country. And as Monica alluded to, with our boom bust economy, purchasing in a recession now may allow for huge property appreciation when things recover. So, in summary, if you make good decisions and are careful, you can not only survive, but you and your real estate portfolio can thrive. Again, my contact information is on the screen. If you have any questions or you want to reach out and learn more about real estate investing opportunities in Calgary, please reach out to me anytime.
Thanks, John, for a great